Hi, I'm Alan, and this is the first Forex video in a series of videos about candlestick trading. I'm going to take you through candlesticks step by step so that you will be able to find better entry signals when trading the Forex market. There are different types of charts, but it's my opinion that candlestick charts are the easiest to read and are also the best for reading market sentiment. In this first video, we will be talking about candlesticks in general, but mostly about the different types of candlestick charts so that you'll be able to determine which type of candlestick chart is best for you. There are different time periods associated with charts. If this was a 5-minute chart, each candlestick would represent 5 minutes of price action. For example, if this candlestick opened at 12 o'clock, it would close 5 minutes later at 12:05. At 12:05, a new candlestick would open, and then it would close 5 minutes later at 12:10. After 1 hour, there would have been 12 candlesticks produced. If this was a 1-hour chart, each candlestick would represent 1 hour of price action. After 1 day, there would have been 24 candles produced. So which charts should you be using? The 5-minute charts, the 1-hour charts, the 1-day charts? I would like to give you a few things to think about before making a decision on which charts you should use in your trading. Charts with shorter time frames are less reliable and the potential for profit is usually smaller. So if a 5-minute chart is less reliable than a 1-hour chart and also will give you less profit on a trade, why would you ever want to use a 5-minute chart? Well, a 5-minute chart generally carries less risk per trade than a 1-hour chart, and it also gives you many more trading opportunities since the trades do not usually last as long as trades taken based on the longer term charts. Here's an example of what we've been talking about. On this 5-minute chart, if you decided to enter a long trade here, you would be risking about 20 pips if you placed your protective stop below the most recent low here. This trade might then last only 2 or 3 hours if you exited somewhere around here. Your profit would be about 50 pips. You would have risked 20 pips for a profit of about 50 pips. However, on this 1-hour chart, if you decided to enter a long trade here, you would be risking about 60 pips if you placed your protective stop below the most recent low here. That's triple the risk as seen on the 5-minute chart. This trade might last several days to a week or more as compared to just minutes or hours when using the 5-minute chart. But on the other hand, your profit potential on this 1-hour chart will also be larger than on a 5-minute chart. You might have ended up with over 300 pips of profit on this trade, but to get that profit, you would have risked 3 times the amount of risk that you did on the 5-minute chart trade. Another difference between longer and shorter term charts is the amount of trade opportunities. Since a 5-minute chart will produce 12 times as many candles as a 1-hour chart, there will be more entry signals produced on a 5-minute chart. This means you will have more trading opportunities. As an example, on this 5-minute chart, you may get an entry signal here, another entry signal here, another entry signal here, another entry signal here. You may get 4 entry signals over the period of maybe 6, 8, 10, 12 hours. However, if we switched over to this 1-hour chart, you may get an entry signal here and not have another good entry signal for a week or more. So as you can see, if you want to trade more often, you will want to use the shorter term charts. So which chart you use depends on how often you want to trade, the amount you want to risk, how reliable you want your signals to be, and how long you want to stay in a trade. I personally use the 5, 10, 15, and 30-minute charts and occasionally the 1-hour charts. The shorter term charts may not be quite as reliable as the longer term charts, but I prefer to enter and exit trades more often. I don't have the patience to wait 3 days between trades. This is my personal preference, but you'll have to decide what's best for your personality. On our next video, What Are Candlesticks?, we will learn about the different parts of the candlesticks and how they're used in trading. This is the second video in a series about candlestick charts, what they are, and how to trade with them. If you haven't seen the first candlestick video yet, you might want to take a look at that too. Otherwise, you could be missing some important information that might help you become a better trader. In the first candlestick video, I explained the differences between candlestick charts and which ones are best for trading. In this video, we'll be talking about the different parts of the candlestick. Once you learn the anatomy of a candlestick, you'll be ready to learn the different candle patterns and how they can be used to help pinpoint good entry points for trades. This illustration shows two candles, one red bearish candle and one blue bullish candle. With most charting packages, you can make the candles any color you want. I prefer to have candles that are red if they are bearish and blue if they are bullish. If the price opens, drops lower, and then closes lower than its opening price, it's a bearish candle. All bearish candles on the charts I will be showing you are red. If the price opens, climbs higher, and then closes higher than its opening price, it's a bullish candle, and all bullish candles on the charts I will be showing you are blue. A candlestick has a body, and usually an upper shadow or wick, and a lower shadow or wick. The body of a candle is the thick column bounded by the opening price and the closing price. For example, on this red bearish candle, the price opened here, which is the top of the body, and closed here, which becomes the bottom of the body. The highest price reached during the formation of this candle is represented by the top of the shadow, and the lowest price reached during the formation of this candle is represented by the bottom of the shadow. For example, if this candle was seen on a 5-minute chart, the price would have opened here. It would have climbed to this high sometime during that 5-minute period. It would have dropped to this low sometime during that 5-minute period. And then it would have closed here at this price at the end of the 5-minute period. Some candlesticks have no shadows on one or both ends of their body. For example, this candle opened at this price and then climbed up to this price and closed at its high price. The price never got higher than its closing price, therefore there's no upper shadow. The next candle opened here, dropped down to this level, and closed at its lowest price. Since the price never got lower than its closing price, there is no lower shadow. Some candles have very small bodies. This happens when the opening and closing price of the candle are the same or very near the same price. On this candle, the price opened here, moved as high as this and as low as this, and eventually closed back at or very near its opening price. When the price opens and closes at or near the same price, the candle is called a doji. There are many different kinds of doji candles, and we will discuss the most important ones in a subsequent video. By studying candlestick patterns closely, it's possible to better understand the market sentiment. For example, a large blue candle is bullish, meaning that traders believe the current price is too low, and they are buying at a rate that is driving the prices higher. On the other hand, a large red candle is bearish, meaning that traders believe the current price is too high and they are selling at a rate that is driving the prices lower. By looking at specific candlestick patterns in relation to the trend, you can predict with a reasonable amount of accuracy when a market is ready to reverse its direction. In our next video, we'll begin discussing the different candlestick patterns, how to interpret them, and how to spot market tops and market bottoms using them. By the time you're done with this series of candlestick videos, you will have a pretty good idea of when and where to enter trades that have a high probability of success. This is the third video in a series about candlestick charts. If you haven't seen the first two videos yet, you'll definitely want to take a look at those before watching this one. In this video, you'll learn how candlesticks can be used to help pinpoint market reversal points by understanding market sentiment. Determining reversal points is the golden goose of trading, and understanding candlestick patterns can help in your decision making when it comes to getting into or out of a trade for maximum profitability. The first type of candle we're going to talk about is regarded by many as the most significant, the Doji, spelled D-O-J-I. There are different types of Doji candles, and I'll be showing you what I feel are the most important ones to recognize. The first Doji we're going to look at is the Doji star. The opening and closing prices are near the bottom of the candle, and the shadow shoots up like a star. When you find the Doji star at the top of an uptrend, it signals a reversal of the trend without needing any further confirmation. Look to exit a trade when you see a Doji at the top of an uptrend, especially when the prices begin to range. This is a Doji located at the bottom of a downtrend. When you see a Doji at the bottom of a downtrend, you need to see a good bullish candle following the Doji to confirm the Doji. This next Doji is a gravestone Doji. With a gravestone Doji, the open and close are both at the lowest point of the candle. This type of Doji gives more reliable signals at the bottom of a downtrend than it does at the top of an uptrend. This is a gravestone Doji at the top of an uptrend. And here is a gravestone Doji at the bottom of a downtrend. Remember that when a Doji is seen at the bottom of a downtrend, it needs a strong bullish candle following it to confirm the signal. This is a Doji dragonfly. With a Doji dragonfly, the opening and closing prices are both at the top of the candle. It's the opposite of the gravestone Doji, which has the opening and closing prices at the bottom of a candle. An extensively long shadow on a Doji dragonfly at the bottom of a downtrend is very bullish. And once again, at the bottom of a downtrend, the following candle needs to be a strong bullish candle to confirm the Doji. In this case, there is not a strong bullish candle following it, so it does not confirm this Doji. Here's another Doji dragonfly, and this one is located at the top of an uptrend. As you notice, the following candles are bearish candles which are confirming the Doji signal. There are a few other important things that you need to know about Doji candles. The first and most important is that reversal candle patterns appear only at the top or bottom of trends. Here is a Doji that is not at the end of a trend. It is not at the top of an uptrend, and it is not at the bottom of a downtrend. If a Doji is not at the top of an uptrend or the bottom of a downtrend, ignore it. Also, if you see many Dojis on a chart, then the appearance of a new Doji will not carry that much weight. It will not be as important as if it's the only Doji. In this case, we see a Doji here, here, and again here, and here, and here. And since there are so many Dojis, one more Doji will not be very significant. Another thing about Dojis is that they have more relevance at the top of a chart if they follow a long blue candle. In this case, a long blue candle followed by a Doji at the top of a trend is a very bearish signal. The same is true in reverse at the bottom of a downtrend. Dojis have more relevance at the bottom of a downtrend if they follow a long red candle. In this case, there's a long bearish candle followed by a Doji followed and confirmed by a bullish candle, a strong bullish candle. In this case, this Doji is very significant. Here's another thing to be aware of concerning Dojis. The trend was originally down, and now the trend has reversed upward. After the trend has reversed upward, you see a Doji right here formed during the beginning of the new uptrend. A doji near the start of a new uptrend indicates that the last of the sellers are getting out. The sellers are trying to bring the price down, but they can't maintain it. In this case, with the following blue candle, bullish candle, confirming the doji, this doji is has a very high probability that it will be the bottom of the trend and that the trend will now resume upward. Well, there you have it. Dojis are important candles for predicting market reversal points. But before finishing this video, I must mention one more important item. Never take a trade based only on a candlestick pattern. To get into high probability trades, you must have other signals or indicators confirming the candle patterns. This is the fourth video in a series about candlestick charts and candlestick patterns. In this video, we'll be covering 4 similar candle patterns, which are some of the most reliable of the candlestick patterns: the bullish engulfing pattern, the bearish engulfing pattern, the piercing pattern, and the dark cloud cover pattern. The bullish engulfing pattern consists of 2 candles and is located at the bottom of a downtrend. The first candle is a bearish red candle. The second candle is a bullish blue candle that closes higher than the body of the previous red candle. In other words, the red candle body is completely engulfed by the body of the following blue candle. Shadows are normally not a consideration, but ideally the blue candle will close at or very near its high price with very little or no shadow. If there is a long upper shadow on the blue candle, the bullish engulfing pattern is not quite as strong as if there is little or no upper shadow. When the bullish engulfing pattern occurs after a fast move down, there will be less stock to slow down the reversal move. In other words, if the market moves down very fast, there is a good chance that it will also move back up very fast when it reverses direction. If the blue candle body engulfs the body and the shadow of the previous candle, there is more power in the reversal. In other words, the reversal is more powerful when the body of the blue candle closes higher than both the body and the shadow of the previous red candle. Also, when the blue candle body engulfs more than just one previous candle, there is more power in the reversal. The bearish engulfing pattern is the opposite of the bullish engulfing pattern. It consists of 2 candles and is located at the top of an uptrend. The first candle is a bullish blue candle. The second candle is a bearish red candle that closes lower than the body of the previous blue candle. In other words, the blue candle body is completely engulfed by the body of the following red candle. Shadows are normally not a consideration, but ideally the red candle will close at or very near its lowest price. If there is a long lower shadow on the red candle, the bearish engulfing pattern is not as strong as when there is little or no lower shadow. When the bearish engulfing pattern occurs after a fast move up, there will be less stock to slow down the reversal move. In other words, if the market moves up fast, there is a very good chance that it will also move back down fast when it reverses direction. If the red candle body engulfs the body and the shadow of the previous candle, there is more power in the reversal. Also, when the red candle body engulfs more than just one previous candle, there is more power in the reversal. The piercing pattern is a very similar pattern to the bullish engulfing pattern. The piercing pattern is a 2-candle formation after a downtrend. The first candle is a red bearish candle, which is a continuation of the downtrend. The second candle is a bullish blue candle where the body closes more than halfway up the first red candle. Ideally, the blue candle will close at or very near its highest price. The longer the red and blue candles, the more forceful the reversal. And the higher the blue candle closes up into the red candle, the stronger the reversal. The dark cloud cover pattern is a bearish counterpart to the piercing pattern and is very similar to the bearish engulfing pattern. The dark cloud cover pattern is a two-candle formation and is located at the top of an uptrend. The first candle is a blue bullish candle, which is a continuation of the uptrend. The second candle is a bearish red candle where the body closes more than halfway down the previous blue candle. Ideally, the red candle will close at or very near its lowest price. The longer the blue and red candles, the more forceful the reversal, and the lower the red candle closes into the blue candle, the stronger the reversal. These four candle patterns that we've talked about in this video can be very powerful indications that a trend is ready to reverse its direction. When these candle patterns are used in conjunction with other confirmation signals, they can get you into some very high probability trades. This is the fifth video in a series about candlestick charts and patterns. In this video, we're going to cover hammer candles and hanging man candles, along with morning star patterns and evening star patterns. The hammer candle has a very small upper body at the top with a shadow on the bottom. The shadow is at least twice as long as the small body. The hammer candle is found at the bottom of a downtrend. The color of the body is not important, however, a bullish blue body is slightly more bullish than a bearish red body. There should be no upper shadow or a very small upper shadow, and the longer the lower shadow, the more powerful the reversal signal. The candle following the hammer candle needs to confirm the hammer signal with a strong bullish move. The hanging man looks the same as the hammer, except it's located at the top of an uptrend, while the hammer is found at the bottom of a downtrend. The hanging man has a small body at the top with a shadow on the bottom. The shadow is at least twice as long as the small body. The color of the body is not important, however, a red bearish body is slightly more bearish than a bullish blue body. There should be no upper shadow or a very small upper shadow, and the longer the lower shadow, the more powerful the reversal signal. The candle following the hanging man needs to confirm the hanging man signal with a strong bearish move. Before explaining the morning star pattern, you must first learn what an indecision candle is, as it helps form the morning star pattern. An indecision candle is a candle that is neither bullish nor bearish. It shows that the market has not decided which way to go, up or down. Indecision candles have small bodies or no bodies, which means the opening price and closing price are the same or very near the same. Indecision candles are often doji candles. The morning star pattern is usually consisting of three candles at the bottom of a downtrend. The first candle is a red bearish candle. The second candle is an indecision candle, and the third candle is a bullish blue candle that closes at least halfway up the first red candle. The longer the red and blue candles, the more forceful the reversal. The more indecision of the indecision candle, the better probability that a reversal will occur. The further the third blue candle closes into the first red candle, the stronger the reversal. It's even stronger when the blue candle closes higher than the first red candle. There are countless variations to the Morningstar pattern. Instead of just one indecision candle, there can be 1, 2, 3, or even 4 indecision candles. The indecision candle can be bullish or bearish. It can be a gravestone doji or a hammer. There are many variations to the Morningstar pattern, but they all have the same thing in common. A bearish first candle, followed by 1 to 4 indecision candles, followed by a bullish blue candle. The evening star pattern is the opposite of the morning star pattern. It usually consists of 3 candles at the top of an uptrend. The first candle is a blue bullish candle, the second candle is an indecision candle, and the third candle is a bearish red candle that closes at least halfway down the first blue candle. The longer the blue and red candles, the more forceful the reversal. The more indecision of the indecision candle, the better probability that a reversal will occur. The further down the red candle closes into the blue candle, the stronger the reversal. It's even stronger when the red candle closes lower than the first blue candle. There are many variations to the evening star pattern. Instead of just one indecision candle, there can be 1, 2, 3, or even 4 indecision candles. The indecision candle can be bullish or bearish. It can be a shooting star or a hanging man. There are many variations of the evening star pattern, but they all have the same thing in common: a bullish blue candle, followed by an indecision candle, followed by a bearish red candle. In our next video, we're going to cover some more important candle formations and patterns, along with some additional candlestick rules that you need to be aware of if you want to be a successful trader. This is the 6th and final video in a series about candlestick charts and candle patterns. In this video, we're going to cover shooting star candles and inverted hammer candles, along with some additional candlestick rules that you need to be aware of. The shooting star is found at the top of an uptrend. It has a small body with an upper shadow, and the upper shadow is at least twice as tall as the body. The color of the body is not important. However, a red bearish body is slightly more bearish than a blue bullish body. There should be no lower shadow or a very small lower shadow, and the candle following the shooting star should be strongly bearish to confirm the reversal. Also, the longer the upper shadow, the higher the potential for a reversal to occur. Another thing to watch for is that a shooting star will often end up being the centerpiece of an evening star pattern. Once you spot a shooting star, you should then start watching as the next candle develops. If the candle following a shooting star is a strongly bearish red candle, you will not only get a confirmation of the shooting star candle, but you will often get the third candle in an evening star pattern. The inverted hammer looks like a shooting star, but instead of being located at the top of an uptrend, it's located at the bottom of a downtrend. It is also similar to a gravestone doji, except it has a slightly larger body. The inverted hammer has a small body with a long upper shadow, and the upper shadow is at least twice as tall as the body. The color of the body is not important. However, a blue bullish body is slightly more bullish than a red bearish body. There should be no lower shadow or a very small lower shadow, and the candle following the inverted hammer should be strongly bullish to confirm the reversal. Also, the longer the upper shadow, the higher the potential for a reversal to occur. Another thing to watch for is that an inverted hammer will often be the centerpiece of a morning star pattern. Once you spot an inverted hammer, you should then start watching as the next candle develops. If the candle following an inverted hammer is a strongly bullish blue candle, you will not only get a confirmation of the inverted hammer candle, but you will often get the third candle in a morning star pattern. One last candlestick pattern that I would like to point out to you are railroad tracks. Candlesticks that form railroad tracks are often good places to enter a trade. Railroad tracks are formed when one candle closes at or very near its high or low price, with the following candle reversing direction at that same price. As you can see, this red bearish candle closed at or very near its low price, while the following blue candle opened at that same price and moved higher, closing near the high of the previous red candle. Here is another set of railroad tracks at the top of an uptrend. The first bullish candle closes at or very near its highest price, while the second bearish candle drops from that price and actually closes lower than the previous blue candle. Now that we've covered the most important candle patterns in our video series, there are just a couple of final things I'd like to point out. As I've mentioned in previous videos, you should never enter a trade based solely on candlestick patterns. You should always get some type of confirmation signals from other indicators before placing a trade. As you can see in this chart, there was an excellent candlestick pattern, a bearish engulfing pattern. But since there were no confirmation signals, this trade would have been a loser. Also, there is one final bit of advice I'd like to give you concerning candle patterns. This is some of the best advice I could give you because it can help keep you out of losing trades. Always wait for a candle to close before making a trading decision based on that candle. In other words, don't try to anticipate how a candle or candle pattern will look before it's actually closed. For example, take a look at this candle. When this candle's price was down to here, you might have anticipated that it was going to finish an evening star pattern. If it had completed the pattern as you anticipated, you would have had a very good entry signal for a short trade. However, by waiting for the candle to close before making a trade decision, you would have seen that it ended up not forming an evening star pattern. If you had anticipated what this candle was going to do before it actually closed, you might have entered into a short trade that would have turned out to be a losing trade. So never enter a trade based on a candle that has not yet closed. Well, that's it for this series. I hope you enjoyed the videos and will be able to use the information you've learned to improve your trading.